everyone has two businesses, should have two businesses, the ones that make them a living and the banking business, which makes everything you do more efficient because you're getting to recapture opportunity costs, you minimize your taxes, if you're credit protected. So there's a lot of benefits to that access to capital.
Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Let's go. Hello and welcome to another episode of the Ideal Investor Show, where, as you know, once a week we bring you a great guest who can help us explore new things, change our mindset, get into the right frame of mind, or introduce us to something new. And I know for a fact today's guest, Curtis May, could do all of that. But first, let's welcome Curtis to the show.
Axel, thanks for having me.
Absolutely. And I know you have so much experience, so many things that we could do. So we kind of calibrate a little bit of what we're going to talk about it today. But before we dive into that, could you do me and mainly the audience a favor to tell us a little bit how got Curtis to where he is today and what's kind of like the main thing you do on a day-to-day basis?
What got me to where I am today. So I'm told I'm one of the top people in my field. So my coach says, just step into your authority, stop being bashful about it.
Totally.
And where our goal is to be the top, what I call holistic, really holistic, not just a bunch of stocks, planning firm in North America, really working geared towards real estate investors and entrepreneurs. Because I think typical advice is really bad for them. The Dave Ramsey stuff. Played basketball in college. Short answers. I realized the NBA was not looking for 5'11" shooting guards. And I got my insurance license. And a couple years later than that, my investment license. Evangelical about buy term and investor difference for about 15 years. And then I read a little purple book called Rich Dad Poor Dad. And I was like, wait, what he's doing and what I'm talking about are different. Then around in that same 3 or 4 month period, I don't even know how I got it, but somebody sent me or I bought the Becoming Your Own Banker. Didn't understand it, and then it took me a minute to kind of work through that and just rewire my brain. And I work really. What got me here is the fact that I work. My dad used to always say to me, we were in a supermarket growing up, and he would say, "Look, your store's got to be open." Which translation, get up and go to work. You got to make stuff happen. There's no check waiting for you. So a lot of times, new investors. I was talking to a guy that started a fund, but he had a job, so he was investing in wholesaling on the side. But it's different when you have no net, like no. You've got to learn to be what I call a work creator, because now you're living 100% in a performance economy. And because the hours for dollars economy is performance economy. Fortunately, I learned that in my 20s, and my dad told me you're never making money work for somebody else. But then what got me here is I realized what business actually I was really in, which was the marketing business, right? I had to learn how to let people know I could serve them. I had to get out there. I had to attract my ideal client to me. And I think that rather than chasing people down, or convincing people, all that stuff. If I tell people, if you love Dave Ramsey, don't call me, because it's your money, not my money. And people that find me, their goal is work optional income. And I try to teach them that to kind of lead their wealth. And you need like they call it medicine care coordinator. So I help coordinate. I'm like the macro manager. If you look at this little, if you're watching this little tool behind me, we call it personal financial snapshot. I can get all of people's financial stuff on one page, and then we can break it down and introduce you to specialists. Do you need a trust? Do you need this? Do you need that? You need a good tax person, so to speak.
No, that's great. Thank you for describing that, Curtis. Now, just to kind of position this a little bit, when people reach a certain level, or their businesses, like you said, you're doing individuals and businesses, when they reach a certain level, then I don't know if eligibility is really the right word, but in a sense, they kind of qualify themselves to be ready for like a family office kind of support. Can you kind of position a little bit? Are you that?
Yeah, I'm trying to bring that concept to, my average client makes between, I want to say 150 to $500,000.
Yeah.
So a family office is going to touch them. You know what I mean? You don't have that kind of capital, but you can operate like that where you're buying assets. We call them cash flow engines, right? Things that send you a check.
Right.
You're using leverage, you're building what I call financial freedom, which I know is what you teach people. So we say financial freedom is a capacity. So it doesn't matter what you make. Are you? I don't care. I just got a phone with somebody who was making 50,000 because I spoke at this school on insurance last week. One of my clients, the principals, he asked me to come out, but she's pretty sharp and she saves $20,000 a year or whatever she's doing. It's a household thing. But what happens is it's like, all right, what are you a good steward of your resources? It doesn't really matter where you're at, what you're at, your net worth is. I'm like Merrill, whatever, right? Whatever. Well, they don't want to talk to you unless you have $250,000 of investable assets, not assets, money that you can invest with them. Good luck with that. I mean, that's they don't help you build wealth. They're what I call wealth managers, but you build it through your knowledge, your assets, your experience. And so it's really be, do, have, right? So we're the four asset classes: business, real estate, paper, and commodities. And when you look at people who build wealth, they build businesses and they buy real estate, or they're highly paid W-2 people, and they use that cash flow to buy or build cash flowing assets.
Yeah, actually, I mean, people know me and maybe when we get together again, I use the term Henry. I don't know if I'd mentioned that to you, like
Oh, high income, not yet rich.
high earning. Yeah.
High earning.
One thing that I know, and you actually show it in the background there for those watching this as a video, is based on 5 principles. Let's talk about that a little bit. What are those 5 principles? Why are they so important?
So you want to, because what people do is they're chasing performance, they're chasing product, they're chasing rates of return. But Ray Dalio says all successful people operate by principles, right? So success leaves clues. So they're not my principles, but if you look at successful people, you'll see them, right? And so the principle number one, so I'll just give them real quick and we can go deeper
Right,
if you want, but they're pre-step before this. So let me give them, I'll tell you the pre-step. So principle number one is save, right? Save what? 15 to 20% or more of your gross income. See, most people think they should pay themselves first, and that means invest and fund their 401k. Investing is literally number 5. Okay. Save, let me define savings: safe, liquid, accessible, guaranteed. So you got to pay yourself first, and savings automatic and systematic. So if you're making 200 grand a year, you should be, Curtis would want you saving $30,000, right? And so if you don't have like 3, 6 months of that, don't even talk to me about a mutual fund or whatever, right? Because you need to call a fortress of solitude, because everything is not always going up, right? And you have to have a plan that works no matter what, which is why we teach principles. Principle number 2 is maximum protection. Okay. Think Game of Thrones. Anytime you see like a medieval war, there's a moat around your castle, right? To protect yourself. So you
Right.
got to protect your stuff. Like I'll work with actual real estate investors and they'll have, oh, I got 4 LLCs. Okay. Do you have an umbrella policy? What's that? You know,
Right.
uh,
Right.
I had a guy that has 8 properties, $2 million worth of assets. We took him through this model on his car insurance, bodily injury, 1530 of liability covers. That means, you understand, if you hit somebody and they were out of work a year and it was your fault, boom, I don't care what LLCs you got, all of the assets are in play, right? So by looking at the model, I was helping him to, what is the maximum coverage? 250, 500, damage, uninsured motor. So we just take people all the way through that process, making sure that you're bulletproof so that you can protect what you've built. See, I'm the defensive coordinator, right? So I'm trying to make sure that
Right. Right. Yeah.
you don't lose, right? For the third one is full replacement of assets at death, guaranteed. So let me go back to 2. 2 is proper life insurance, wills, trusts, entities, all that is under protection, right?
Yeah. We
And so
call that basically the estate, and then how do you protect it?
yeah, and so that's my principle 2, all that stuff.
Yeah.
Um, principle 3 is I want full assets at death, guaranteed. So that's why we build our foundation on whole life insurance, because I'm not a big fan of universal life because there's nothing in it guaranteed. So I want to make sure what we do is going to be there guaranteed. See, I like certainty and guarantees. So everything I
Right.
do is built on certainty because that's what principles are. The fourth principle is liquidity. See, people, so they want to get property, roll into the next property, and they give, well, I got a line of credit. Yes, but that could dry up. You need cash. or cash money you could access that you could control, right? And so our goal is 6 to 12 months or more. So your first 3 months is your emergency fund, but really everything above that is your opportunity fund. So when you have capital, I heard say Nelson Nash should say, um, he who has the goal make the rules. So if you have money, opportunities will find you. You don't even have to go looking. So we try to get our people liquid, financially literate, so they can tell the difference between asset and liability. And then all I want you to do is when you see something you like, you have the capacity to do it wherever you see. And then the fifth principle, which really dovetail in what you're talking about, I like, is we call it the velocity method over the accumulation theory, right? And so most people, accumulation is buy and hold, dollar cost average, get out of debt, buy term investor difference. Um, Whereas if you took a corporate finance course, they don't teach any of that stuff.
Right.
It's velocity, is velocity of money, which on real estate, that's the Burr method, that's using leverage. It's cash flow. Because people focus on their net worth, but that's what I call a lag indicator, because you can't eat equity, right? So
Well, then,
you're
and I mean, it's only after you have already accumulated it, is it basically added together to say, are you like accredited, for example, or stuff like
yeah,
that, right?
yeah, but you can't eat it,
Yeah,
right? You can't eat equity, right? And so what if you I don't know if the chart's probably small, but we track we do last assets, liabilities, business liquidity, personal liquidity, but I track cash flow from assets. I track your business income, that the numbers we pull off of a person's P&L. So I want your net profit,
right.
because that's what we want to grow every year. So we review this I have a program where I meet with people quarterly, and we really go over the cash flow. But every year we want to review this. So like Dan Sullivan says, you got to measure backwards, right? So I want, if you had $6,000 a year passive income, and Curtis, I want $20,000 a year. But this time, let's say we're meeting this time next year, and it was up to 7. Okay, that's amazing, because if you measure backwards, you've grown. Because there's a book, Gap in the Game. We stay in the gap because we're always chasing the ideal, the horizon. So we're always beating ourselves up because we didn't hit our number, right? So you got to give yourself a
Yeah,
little bit of
well,
grace.
and those numbers are oftentimes quite ambitious. But what I wanted to just make sure that the audience is aware of that when Curtis speaks about the business income, there's obviously two different ways to look at it. The one is when you look at your investing as a business, which I also a big fan of, and basically mentor everybody who comes to us and becomes a client. That's kind of like number 1.5 after talking and getting to know each other.
Right,
Besides
right,
the investing. But then the other thing I want to point out, and just so people that listen or watch us have that separation when and I'm sure it's the same with you, working with a business owner, right? So they have their business P&L as well, and their business income and stuff. And most business owners I know want to grow that too, partially so they can make more investments, but also to grow the business, get new people, and produce more product, find new clients. So there's kind of in a case where we, as you and I, are serving a business owner, they have basically their investing business and their other business, versus somebody who has a W-2 job and then they make the business for investing.
Well, and here's the thing. One of the things I found is missing also is that your financial plan precedes the business plan, right? The business is so financial plan, meaning what do you want and
Yeah,
why,
yeah, right,
right?
right,
So the step before the 5 steps I added on was spend less than you make. So I teach something called cash flow mapping. I have our own software that we use, but if y'all have ever read Profit First, it's similar to that, where you got to learn how to, if you leave all your money in your business because you call yourself bootstrapping, the business will eat up all the money you leave there, right? So you have to pay yourself, you have to take profit, so most wealth is lost by how people manage cash flow. So I'm really big into helping people create a constructed one, separate church and state, right? So business accounts,
right,
personal accounts. What I like to do is help people figure out, well, what are your life costs,
right, right.
right? What do you need for your kids to go to school where you want them to go, to drive as you want to drive, all that stuff. And then because you gotta tell your business what it needs to do for you so you can live your life. See, the business is there to serve you. That's the engine that drives the car. So if you need 7 grand a month for your lifestyle, and you're only grossing $10,000 a month, well, that's a problem, right? But that's your business talking to you saying, okay, I need to make more money. I need to, or I can't be full time in real estate. I need to keep my operating business, or I need to keep my job because I got to let these assets grow so that I can replace my income. And so it's a good measure, the two of them together. So I probably spend half of my time when I meet people just trying to calibrate their cash flow. And then we follow them through the model so that we can track. But the game is won and lost at cash flow control.
Now, when you're speaking about cash flow control from the reserves perspective, are you limiting that? Are you saying, okay, out of the cash flow, when I'm talking about investment cash flow, you should have X amount liquid available basically for any kind of repairs?
To me, it depends on the person, how volatile their business is.
Yeah. Okay, that's an interesting thing. The way we do it, just for the audience as a reminder, is we're basically looking at the number of properties that we're trying to basically maintain. And I don't mean like in,
Yeah.
traditional maintenance, but we have them, they are investment properties. So from that perspective to say, okay, the way I do it is to say, what is the most expensive thing that might have to be replaced?
Right.
So let's just say the most expensive thing were a roof. Right. And so then now, obviously, you wouldn't want to say, okay, will all, in my case, I have 9 properties, would 9 roofs fly away or be rotten through all at the same time? No, probably not. But if there's, for example, a cluster of properties like what we have, and there's a storm going through, it's possible that 2 or 3 might get damaged. Now, you can always argue about insurance and blah, blah. But for me, I'm just looking at it to say, okay, so risk or probability is, let's say,
Right. I
30%.
wouldn't depend solely on that.
Yeah, right. But so if you say, okay, it's 10,000 a roof, probability is 30%. I have 10 properties, so I need to have enough money for 3 roofs. Which then also means in return is, since that's the most important, most expensive thing that can break, I should be fine for everything else. Because ultimately, the reason that we're looking at it that way, and I'm curious to hear what you say about that, is there aren't very many good ways to have a lot of liquidity basically with a day's notice. And if you have it, then it typically doesn't perform very well. So it's a balancing act. And that's, if you say, okay, well, I want to have a year's worth for 10 properties, that's a lot of money getting like what, 3% return or something like that. So there's a little bit of a balancing act to say, how
Well,
much
think
do you
about how
keep?
much Buffett has cash in liquidity. It's not cash, like sitting in a checking account. But so how I do that, so that brings me into principle one, save,
Yeah,
right? Because you have to, so I equate savings with capitalization. So you want to capitalize so that you have money available to invest. And so if you capitalize the preference, because you're chasing returns, you got to let go of the chasing returns. What you want is control of a pool of capital. So that brings me into the strategy, which is we teach be the bank, right? So where we store cash, not to get into, I'm not going to go deep into a product, but properly structured dividend paying whole life with a mutual company is where we store past having like a couple months in the bank operating income,
right.
then
Yeah,
major capital we store in policy. So now my clients, if they had a roof, I got people with 200,000 in cash value, right? So now what happens is you should keep a day's notice in the bank, what I call ATM money. You have that situation, you don't need the money tomorrow because it's not going to happen that fast, but you can get to the insurance money in 3 days, 4 days.
yeah. I always say a week.
Yeah,
Yeah,
we just be
yeah,
safe. And so, because they'll tell you when you call them 3 to 5 days, but you can get it. All they're going to ask you is how much you want, which is predicated by how much you put in. That's what you have to capitalize.
right.
And then you want to check, you want us to wire it to your account. So it's no like, let me see your social. Let me, what's the purpose of the money? How's your credit score? None of that stuff. This is what it means. You want to begin to, if you got cash flow, what you want to do is begin to eliminate your dependence on third party capital, right? But Rome wasn't built in a day. So you got to put away some money. But what we teach is the banking system process becomes the platform for where you hold your capital. And then what do you need capital for? Major, we call it two things that you, so the framework we teach is earn money, bank it, borrow it, spend it, repay it. Okay. And repeat, right? So earn it, bank it. That means save it somewhere, let you be the bank, spend it, collateralize your savings. I mean, borrow it, collateralize your saving, spend it. What do you spend it on? Primarily, right? Major capital purchases, meaning anything you can't pay for in full within your cash flow, like a roof, like a turnover, like a down payment, or I got people that can buy the whole house with their policies. They've been doing it with me for 4 or 5 years and make good money, and they're aggressive savers, and then repay it. So if you were to, this is where you can now, because Nelson was saying you everyone has two businesses, should have two businesses, the ones that make them a living and the banking business, which makes everything you do more efficient because you're getting to recapture opportunity costs, you minimize your taxes, is their credit protected. So there's a lot of benefits to that. The magic question is, where do you store your cash? See, it's storage. So I'm not looking for rates of return from storage. I want access to capital because I'm going to make money with what I do with the money. I don't need the thing, the product. There's no product that in of itself is going to take you to glory. It's like, says people are chasing returns, looking for a rate of return, but what you want is cash flow, and what you're trying to build, I believe, financial freedom, which is a capacity, right? You have assets that generate cash flow over and above your expenses.
Let's just, before we go a little bit further into the question, just from a principle perspective. So somebody says, okay, this kind of resonates with me. I don't know, either comes to you or can theoretically go to other insurance agents, say, okay, I want to have a whole life insurance policy.
But go ahead. No, I'm
Yeah,
kidding. Go ahead.
well, let's say there were other people than
Right.
Curtis May that do whole life insurance. Get a policy, in basically put money into the policy. Now, basically, the policy has, like we said, guaranteed survival.
Death benefit cash value.
Yeah, exactly. Whatever that thing is called. So,
Mhm.
but what it also means is, if you want to take money out without taking it out of the policy, it's basically not just guaranteed to you, it's also guaranteed to any lender, right? In that sense. So if I say, okay, I don't want to take the money really out of the policy, I want to just borrow against it, I can go to any lender and they would
Oh
do it.
yeah, you can use it's called a collateral assignment.
Yeah, exactly.
Right. So you can go to the bank, say, listen, you could, if you don't want to use it, let's say there's some companies that people I know have policies with companies that charge 7, 8% interest, right? And before recently, you could go, that's high, especially like 3 years ago. And so you could go, and let's say at $100,000 or $50,000 in cash value, you could go, there's certain banks or any bank will do it, and you could just assign the policy as collateral. They'll give you 3, 4% loan,
Right,
and then if you
exactly.
default
Yeah.
it, they'll just take it out the policy.
Yeah, well, they don't even take it out, they leave it in the policy. I mean, there's obviously different ways to do it, but with that, what you just described, the big advantage is that the full amount stays, whatever it is, stays in the policy, and the life insurance company is still using it to invest
Well,
and
but see,
growing.
you don't even have to do that because when you take a policy loan, it is a collateralized loan. So if you had 100,000 and you took a policy loan for 50, they're still paying interest on the entire 100,000. So
Right.
you get
Well,
to
it's just a matter of take the loan from the life insurer or to take the loan.
or somewhere else. See, so what
Yeah.
happens is you want to be in the control position. Sometimes, see, because what you want to be able to do is what I teach people, you want to be able to borrow out of opportunity, not out of necessity, right? Meaning you have the money, and what's the best way to get the money, and then the policy become your security, or maybe you just want privacy, speed, and unstructured payments because of policy, because yours company won't give you any payments. So if you don't want to have to start an immediate payment right away, then you could use the insurance company money, and it's all about control. And then the other part is when you make payments. So let's say the policy, you get money from a policy at 4%, the rates on the policy. So what you would do, though, we call it being an honest banker, is you would create an amortization back to the policy, but I help our clients create that at like 7% or 9%. So now you're recovering. You got
Yeah.
to understand the what I call the financial physics. So you have to treat your money just like the hard money lender or whoever. And so if you had a bank, you should be your own best customer, right? So and charge yourself 7 or 8%. You're just taking the profits you were giving somebody, you're willing to give to somebody else. Now you get to have your cake and eat too. You get growing money, you got the asset you bought, and then you have your money in a safe for credit protected location.
Exactly. So I think we got that pretty well established. One thing
But
that
let me make this point. You can't just call somebody that you know, and this is not a self plug. I'm just saying it's a specialty, right? So I properly structured dividend paying whole life insurance with a mutual company. So that narrows the field from about 1,500 to 12 companies
right.
and about 4 or 5,000 people. I'm being generous that actually know how to do it. So it's not just, oh, so and so works as such. Can you get me a whole lot? Because a lot of times I'm cleaning up that because that's what they did, and it was structured wrong. And why don't I have any money in this policy? Because that's not how it was set up. Because you didn't know better.
Yeah, okay. So you just elevated my guy John a little bit because he's been doing this for me and our clients for 20 years now. And so
Yeah,
I have to
yeah.
tell
See,
him
so
that Curtis said that you are one of the few.
quite a few, right? And listen, you can talk to somebody, and they don't literally beat you over the head with Nelson's book. They don't do it.
Yeah. No, no, I get it. Now, one thing that I've heard, because sometimes, it's not every client um, wants to set it up that way. And I mean, I'm not trying to force anything on anybody. I'm sure you don't do either. But one of the things where people are kind of, oh, it kind of sounds interesting. But I have heard, and I'm just going to tell you what I've heard, and then maybe you have a good explanation of what answer you would give. That, especially in the life insurance business, when you initially set up the policy and you say kind of, what the volume overall should be that you're working towards and so forth, and how long you actually need to make payments and all that stuff, that a substantial portion of the initial quote unquote investment goes to pay the company and the agents. And so that people have said several times, and I have never seen the actual calculation where they say, well, the first 2 years, 3 years, 5 years, you're basically just paying the person who is kind of selling you the policy. What's your take on that?
So remember I said properly structured. That's why you just can't go to anybody and do what I'm talking about, because the most policies do work that way,
Yeah.
right? And Uncle Dave and Susie are right with that regard. It's still long term, it's still an asset. It's still
Right.
better
Yeah,
than
yeah, yeah.
buying term. That's the difference. But for banking, that is a strategy, right? So no, the people that do what we're talking about, they literally back out 50-60% of their compensation. That's why you get early cash value. So we can get, because you can, there is a cost of insurance because you're buying life insurance,
Right.
not a
Yeah,
savings
yeah.
plan. But there's so the IRS has a rule called a modified endowment contract. So they actually limit how much you can put into a policy. So when they're built properly, they're most efficient when you fund it right up to the IRS limit. So it's basically, we make it so it's a big Roth IRA with more benefits. So generally, if somebody puts in, I was showing some example before we jumped in where she was like 35. I said, look, if you paid 12 grand a year, you'd have like 7,800 of cash year one, day one, right? And it will be about 300,000 of death benefits because you're buying insurance, right?
Right. Yeah,
But
yeah.
most of the first year does go, all of the first year base, it's called base premium, goes to the cost of insurance. So where the agent gets paid out of that. But again, we backed out half of what we make money on, right? So that you get early cash value. But year two, in her example, that 12,000, well, 11,500 of the 12 went into the cash year two. Then 11,600, then 11,700. You put in 12, it goes up by 12. You put in 12, it goes up by 13. So it gets more efficient the longer that you have it. But it's definitely to that, they're not, when you say that, they're not wrong, but they haven't got with a practitioner that knows what they're doing
Okay.
because they're structured
Then,
wrong.
right. And then the last question in this context I wanted to ask is because we had a number of clients and they basically understood the concept, they really liked it, but what they were looking for, because they would like to activate the money that their employer made them put into a 401k into basically a whole life policy like you were just describing. We have not been able, even with my friend John, he tried to look into it, but the partner he works with, they don't do it. Is there a way to use your 401k?
Yes and no. So you can't, unless you have like a enforced distribution option.
Why, yeah, if you pay the fine, you can obviously take money out.
Well, no, you can't take it out as long as you're still employed there. Like you have to separate from service. One. Two, it's funny because the securities people don't like you taking money out of it of the
Right.
investments
Yeah.
to put into insurance. So I never really tell people to do that. I just show them how it works, and they may want to do that, but I don't encourage it. I'm not, or same thing when people. I heard people tell people to borrow against their house and put in insurance. Completely bad advice. Okay, don't do that either. If you're listening to this, and so what you got to do is you got to get control of it. So let's say you left your job, you'd roll it over into an IRA, right? So it's similar to a Roth conversion, right? So if you converted a traditional IRA to a Roth, you'd have to pay the 20% because the money went in pre-tax,
Right.
right? And so you would do that. So now you could, so I'm not saying you do this, it's just a thing. You could roll it over into an IRA, right? So now the rollover out of qualified money is not a taxable event. It's just a moving from one pocket to the other
Right. Right.
pocket.
Yeah. Yeah. Yeah.
But now, once it's an IRA, can control the distribution because you control the withholding, right? So if you take it and you're under 59 directly from the IRA, you're going to pay 10% penalty for early withdrawal. You're going to pay the 20% for taxes. So if
Yeah, but
you
that would basically
roll it
be the
over,
same. If you're not
yeah,
working for the same anymore, it would be basically the same if you take it directly, right?
yeah, yeah.
Yeah.
Well, so what you do is better roll it. I think it's better to roll it over if you're not like money's not burning a hole in your pocket, and if it's that urgent, you need to take a breath anyway because there's nothing that deep that where you need to do it. You need to think. That means you're not thinking. You just calm down and make sure
I
there's
know.
too
I
much.
mean, the idea or the question comes up when you say, okay, so I would like to do this, be your own bank. I like the concept of working with whole life. I like the idea that I can then also build my basically passive income portfolio. And I'm kind of stuck with a lot of money from my previous employment in my 401k. That is kind of the scenario.
Yeah, so I never like so here's what I do. I never go in with the product. I want to see so you see the thing behind me, principles,
Right.
right? So because it's not I don't because see what happens is it's not a one-off, right? So why I want to see people saving 15-20% because saving is a principle. I don't care what you make, I don't care if you're retired, you still have to save,
Yeah,
right?
you
Spend
should
less than
actually
you
you
make.
should write a book that is even richer than the richest man in Babylon.
All right. I'm gonna write that down. I'm gonna so I'm working on a book. I'm trying to think of a good title.
I'm just saying, when you say 20 or 30%, that guy did 10% and got pretty
10%,
far.
right. Well, we were still on the gold standard. Then, when the book came out, it was in the 20s. I was like, you gotta save more than that because that's why I upped it because it's like, well, you gotta do more because the dollar don't buy as much. But you gotta save, and so in the savings piece whips helped you have to whip Parkinson's law. It says expenses rise meet income. And so most people, when they make more, they spend more. That's why we teach cash flow control through a tool we use called Currents. And to help people really, we do a cash flow exercise before we even get into all the other stuff to see where your money's going, what's coming in from your business. Are you paying yourself first? What does your life cost? And then you want to set a system where you're saving is your default position, right? So we create a intermediary account, a reservoir account. All your money goes there, and then you move it into your properties, your assets, right? And then you say, all right, listen, my life costs 7,000. So let's say if you're making 10, we only put 7 in the bill pay accounts, and then at 3, you're already saving. So we saved from the get-go. And then, it comes with an app, and we meet with people quarterly, the people we do that with. And then every 90 days, like if you're not going crazy in 3 months, there should be 9 grand of free cash flow. Now, what do you want to do? And so then I would teach them to call you. Okay, I got this free cash flow. We might be storing it in policies. I got enough to pull the trigger on some asset that I've been researching but there's no magic pill. That's why I say principles drive strategy, right? So if you're not saving, we need to figure out why you're not saving. Like I don't even want to talk to you about how to be the bank yet, because if let's say you moved $100,000 in there, what you gonna do next year? Like how much are you saving?
Yeah,
Like
exactly. Well, and I mean, the thing is, I think we are amazingly aligned because the aspect with the principles drives the success ultimately has also to do to some extent with systems. I know that people always struggle when I call it systems, but in a way, right? Like nowadays, especially where we have so many things, everybody has a laptop, or basically their cell phone is kind of like a computer they carry around. And those things have systems called apps on it, right? And I'm not suggesting you have to use an app, but the point is those things, like you said, right? How much do you put aside? Where do you put it? Where does it go? How do you manage it? How do you control it? All these things is basically establishing a system on
Yes, because
how
all
everything.
wealth,
Yeah, yeah,
I
yeah.
heard Dan Kennedy say, all wealth is a product of systems.
Right, exactly. Yeah.
Your point, right? And so
So,
you got a thought process. Jim Rohn says most people don't have a money problem; they have a philosophy problem.
well, and
And
that's the
so the
other part
five
with
principles.
systems is they have a tendency to become habits, right? Like if stuff is automated, is systematized and so forth, you don't constantly have to think, oh, how was this and how much goes there
Yes.
and so forth and so forth. It becomes almost like a habit, right? And so that's also what makes it strong, because then you have, you're not typically
As
people.
long as you got good habits, the principles,
Yeah, yeah,
and
but
if you
also, I
just
mean,
work and
if a
yeah,
habit is working or a system is working, we are just by human nature much less likely to break it or change it
yeah.
because we're getting used to it. So we have touched on a lot of things, and I'm sure
That's what I try to do. Give people habits, make them automated,
yeah,
and then go be do have, right? So work, because investing is more about becoming and buying,
yeah,
and work on becoming, and then when you see something, the money will be there for you to do whatever you want to do.
yeah, absolutely. And I think anybody who's been listening to us now for the last like 30, 35 minutes understands there's so much more there. So if they want to get in touch and say, okay, show me more about the principles, show me more about this other stuff, what should they do?
So I'll give you. I used to give too many ways to contact me, but I'm gonna give you one way.
Yeah.
So text. This is all I remember. I got a couple, but text "Be the Bank," all caps, all one word, BETHEBANK, to 55444. And then you'll be on our mailing list. But what I'll do is I'll send you a free report called "The Value of Liquidity," which is principle 4, and the different ways of when you're talking about where should I store my cash. And then from there, we'll follow up with some other free stuff that we have. And if you like, we can have a strategy session and talk about this. Nothing for sale, because you don't lead with what I call a product, right? It's all
No,
about moving
absolutely. I mean,
while.
it's more
Yeah.
adopting a philosophy, and that's not something that happens
So
by
I want to do is get to know you,
right.
because people say, well, what should I do? It depends. What do you want? And what you want determines what you do.
Right. And it also is driven by where you are right now. Everybody is
Right. And where are you now? It's like,
yeah, yeah,
yeah. And
yeah.
all of that stuff. Like, you can't even make good decisions until you kind of figure out. We call it, and we do a thing called a financial GPS, which is PS is like, all right, well, here's where I want to go. Then it's where are you now? And then now what do we have to do to get you from point A to point B? And that's kind of the framework of how we teach. And banking is part of that, but it's not even step one.
No, I hear you. And that could be a whole different show just to talk about, what is this ever shorter attention span doing to our future that we would like to have, but never spend, or very few people spend significant time.
It's like pulling teeth to get them to read a 85-page book. Right?
Yeah, yeah, exactly. So we're gonna put all those the term what to type in and the number and so forth
And
in
then
the
check
show.
out the Practical Wealth Show if you just want to hear more of the Matt. If you want to just follow along a little bit and get to
Yeah, and
know
then
me.
not too distant future, they can even listen to me on that show.
That's right.
So Curtis,
Well, they can go back. I'll link the other show. You've been on before, right? Have you been on?
yeah,
Yeah. And
yeah,
then,
yeah.
but yeah, we're going to be on recently. So, I got to get great people on the show. So,
Yeah, I
great minds.
appreciate it. Appreciate it. Curtis, totally independent of what we discussed so far, I always ask at the end, if you could meet anybody dead or alive, who would it be and why?
I would like, so I'll stay in the business realm.
Okay,
Um, my favorite entrepreneur is a guy from the 50s. His name was A.B. Fuller.
okay,
And so I read about him in this book by Dennis Kimbro, Success Secrets of Black Millionaires. And he had a Fuller Brush type company, but he was giving away Cadillacs in the 50s. He would do um see people making like serious money in the 50s, dressed nice. I've seen some of the things he should do a Saturday, which inspired me. I do a Saturday class for all our clients, our members, it would call the gospel of success, and he would just get people and teach them about money and success principles. And I would really love to. So this is in an era where if your skin looked like mine, they didn't want to. You people say you can't win, but he proved to me that it doesn't matter. It's just your desire to win, and he wouldn't let anybody keep him down. So I would really,
Yeah,
love somebody that
that
became a
would be,
multimillionaire. Was hard, you
yeah.
know.
Absolutely, yeah. And I mean, I'm always, because I'm originally from Europe, always don't want to be remiss mentioning there are places in the world where the color of your skin really does matter.
Yeah.
Right? And it's good to know
But
that those
it's
exist.
a as Myron Golden would say, it's a contributing factor, but not a determining factor, right? Because there's nothing Curtis can't do when he wakes up because of the color of his skin. So I don't accept that. And so you got, and like I said, if you like Dave Ramsey, don't call me. Like, you ain't not my tribe.
Yeah, same here.
'Cause
So I want to thank you, Curtis, for spending the
Yeah.
time. I know that you have had a pretty tough time recently, very little sleep. So I appreciate that you
Yeah.
brought the energy and you made the time for us. Thank you.
Thanks for having me. Guys, go out there and make it a prosperous day.
Thank you.